All right. Welcome everybody to Live Valuation. I'm Midas Today we're going to be looking at VCTR, Victory Capital. Just give one moment to make sure everything is up and running. Okay. All right. So Victory Capital, they're primarily an asset management company as well as a fund administrator and uh, fund capital distributor. They are owner and proprietor of the Victory Share series of ETFs. I've noticed that in the last several months, though, a decent amount of asset management companies have come up in our screens. I do think that's because of relatively high returns on capital last year for them, which is a bit of ephemeral in the screening process. But either way, whatever. We're taking a look at another one. I have also noticed that they haven't exactly turned out to be very high value once I was done looking at them. So part of the reason I'm looking at it would be one thing if it was showing that up and it was like, oh wow, these actually are all a bunch of slam dunks or something. But they actually don't appear all that appealing once I'm done looking at them. So it's just interesting that the screen doesn't seem to be uh, recognizing their longer term uh, value relative to their success in the most recent year. But either way, so I did do all the prep work for this one, got the debt already lined up in here, relatively simple amounts of debt there. They're only based in the US, so it's pretty simple in that regard, and they will just do investment management and asset management, so that was simple segmentation as well. It is probably going to be a relatively short stream. They only have 5 years worth of data for me to work with. As far as since they were a public company, I could go back further when they were a private company, but I kind of rely on somewhat on their share price data, which I'm willing to kind of fudge a little bit for a year or two with some inferences to kind of play with it for pragmatic sake, but I can only do that so far, so it kind of limits the amount of years that we have available for them. So either way, only 5 years worth of data to plug in, and that's pretty much it, which will give us a relatively short amount of work to do today. But either way, I'm going to play their most recent quarterly call while I do that. That open, cool.
Good morning and welcome to the Victory Capital second quarter 2021 earnings conference call. All callers are in a listen-only mode. Following the company's prepared remarks, there will be a question and answer session. To ask a question during the session, please press star one on your telephone. I will now turn the call over to Mr. Matthew Dennis, Chief of Staff and Director of Investor Relations. Please go ahead, Mr. Dennis.
Thank you. Before I turn the call over to David Brown, I'd like to remind you that during today's conference call, we may make a number of forward-looking statements. Please note that Victory Capital's actual results may differ materially from these statements. Please refer to our SEC filings for a list of some of the risk factors that may cause actual results to differ materially from those expressed on today's call. Victory Capital assumes no duty and does not undertake any obligation to update any forward-looking statements. Our press release that was issued after the market closed yesterday disclosed both GAAP and non-GAAP financial results. We believe the non-GAAP measures enhance the understanding of our business and our performance. Reconciliations between these non-GAAP measures and the comparable GAAP measures are included in tables that can be found in our earnings press release and in the slide presentation accompanying this call, both of which are available on the Investor Relations portion of our website at ir.vcm.com. It's now my pleasure to turn the call over to David Brown, Chairman and CEO. David?
Thanks, Matt. Good morning and welcome to Victory Capital's second quarter 2021 earnings conference call. I'm joined today by Michael Policarpo, our President, Chief Financial and Administrative Officer, as well as Matt Dennis, our Chief of Staff and Director of Investor Relations. I'll start by providing an overview of the very strong financial and operating performance we achieved in the quarter. Then I will cover our investment performance, which continues to be excellent. After that, I will turn it over to Mike, who will review our second quarter financial results in greater detail. Following our prepared remarks, Mike, Matt, and I will be available to take your questions. The business overview begins on slide 5. We made great progress against a number of our strategic objectives during the second quarter and ended the period with total assets under management of $162 billion and long-term assets under management of $159 billion. With solid execution by our distribution and marketing teams, we generated record high gross sales of more than $10 billion in the second quarter. During our last call, I featured a number of highly rated products with significant open capacity that have been tracking assets as investors continue to recalibrate their portfolios. Products like our Morningstar 5-star rated Victory Floating Rate Fund and the Victory Market Neutral Income Fund have continued to attract assets in the current market environment. Combining this with many of our high-performing active equity strategies, new platform wins for products managed by our USA Investments franchise, a robust pipeline, and THB and Alderwood starting to gain traction, we have many reasons to maintain our optimism around our organic growth outlook as we move forward through 2021 and into 2022. Our Victory Shares ETF platform generated positive net flows for the third consecutive quarter. Additionally, there were net flow improvements in our direct investor business that began in the middle of last year and continued through this quarter. All the aforementioned culminated in positive company-wide net long-term flows for the quarter. We are continuing to see the positive net long-term flow momentum in the third quarter as well, keeping in mind we are only a little more than a month into the quarter. Investment performance remains strong, and the investments we are making in distribution and marketing are continuing to yield positive results. Moreover, while we had a few mandates fund during the quarter, our won but not yet funded book of business continues to grow, reinforcing the positive organic growth outlook. Revenues grew 4% from the first quarter and were 22% higher than in the same quarter of last year. Adjusted net income with tax benefit per diluted share grew to $1.18, which was up 4% from the first quarter and up 33% from last year's second quarter. Our integrated operating platform continues to be efficient, with adjusted EBITDA margins coming in above 50% for the fourth consecutive quarter. As we have guided, we allocated the vast majority of our excess cash flow to reducing debt. The $57 million of debt reduction in the quarter lowered our outstanding debt to $681 million at the end of June and improved our leverage ratio to 1.4 times. For the fifth consecutive quarter, we increased the cash dividend paid to our shareholders. With the latest increase to 15 cents per share, we've tripled the dividend compared to the 5 cents per share we distributed in the second quarter of last year. Given our steadily improving cash flow, we are generating sufficient cash to continue our pace of debt reduction while simultaneously returning a greater amount of capital to shareholders. We will continue to evaluate the pace of reducing debt versus increasing returning capital to shareholders as we move forward. Turning to page 6, I'll provide an update on our direct investor business and touch on some new product developments and several broader ESG initiatives. Our referral agreement with USAA continues to generate new investor accounts, and the improving trajectory in net flows associated with this channel has persisted. We are investing for the long-term success of our direct investor business and have been executing on our strategic investments in people, sales tools, and other technical resources to maximize its potential. The second quarter was our best flow quarter for the direct investor business since the acquisition, and customer satisfaction scores are exceeding targets. Our contact center had 140,000 direct interactions with investors during the quarter, which are proving to be valuable touch points. Given this level of engagement, we recently created a new high net worth advisory group dedicated to serving the needs of more affluent investors. While it is still early, we are exceedingly pleased with the sales and services group has generated in a short period of time, and our clients are benefiting from this personal attention, which has provided no additional cost to them. This, as well as results from other trial initiatives, reinforces the confidence in our strategy for this unique part of our business. When we reach a normalized steady state with this business, we intend to report additional KPIs in future disclosures. Turning to new product development, the private cryptocurrency index fund that we announced in June was officially launched a few days ago. The fund provides accredited U.S. investors with an efficient and convenient way to gain diversified exposure to a basket of digital assets in a private fund that tracks the NASDAQ crypto index. The index developed by NASDAQ in collaboration with Hashdex dynamically rebalances its constituents on a cap-weighted basis, thereby reflecting a benchmark for digital assets. Through our partnership with NASDAQ and Hashdex, Victory Capital will be the exclusive sponsor of private funds and other vehicles for U.S. investors based on NASDAQ's crypto index. Additionally, we also filed for an exchange-traded product tracking the index, which, based on our information, is the only registration currently filed for a multi-coin ETF for non-accredited investors in the U.S. who are seeking diversified exposure to digital assets. We've been busy executing on other new product initiatives as well and filed for 3 new active ESG ETFs. First is the THB Mid-Cap ESG ETF, which represents our first active equity ETF. Given the investment performance in THB's mid-cap strategy, our distribution teams are eager to be able to offer it in an ETF wrapper. We also filed registration statements for 2 active fixed income ESG ETFs that will be managed by our USAA Investments franchise, with ESG factors incorporated into the investment decision-making process. We are accelerating our company-wide ESG initiatives on a number of fronts, from actions that further advance our corporate social responsibility at the enterprise level to incorporating responsible investing practices in portfolios to satisfy client objectives. To increase transparency around specific actions we are taking, we recently published our first corporate social responsibility report, which can be found on our website. I encourage you to download and read about the many ongoing activities underway and our future plans. During the second quarter, we announced the Victory Scholars Program and our strategic alliance with Xavier University of Louisiana. We are providing direct financial support to students for expenses not covered by existing grants and awards. In addition, we provided the funding to seed the university's first student-led investment club, providing hands-on learning opportunities. The primary goal of this alliance is to promote equity and social mobility for students of color and to ultimately build a more robust pipeline of diverse, high-quality candidates to fill jobs across the financial services industry. On the responsible investing side, we are proud to have been recently recognized by Morningstar for a proxy voting record. According to Morningstar, we ranked in the top 3 fund companies for our overall votes on climate transparency and climate governance issues. On slide 8, you can see that our investment performance remains exceptionally strong, with the majority of our assets under management outperforming their respective benchmarks for all measurements periods. 22 of our mutual funds and ETFs ranked in the top quartile of their respective peer groups for the trailing 1-year period ending on June 30, with various products managed by our franchises including Integrity, THB, and USAA Investments ranking in the top decile. On a consolidated basis, 64% of our AUM outperformed their benchmark over the trailing 12 months, and more than 70% outperformed over the critical 3, 5, and 10-year periods. In addition, the majority of our strategies also outperform benchmarks on an equal weighted basis. We are actively engaged with a number of prospective M&A targets. While we have no news to announce today, Our strategic acquisition criteria has not changed, and we remain focused on opportunities that will make us a better company. As I said last quarter, and will reiterate again, we are moving potential targets through our diligence process, with some being in the very later stages. Acquisitions are an important component of our overall corporate strategy, and we've prepared our balance sheet to be able to execute. I anticipate that over time, we will execute on a number of wonderful opportunities that will be very value added to our business. With that, I will turn it over to Mike for a more in-depth discussion of our financial results. Mike?
Thanks, Dave, and good morning, everyone. The financial results review begins on slide 10. Revenue increased 4% from the first quarter, reaching $222 million in the second quarter of the year. Our operating margin expanded 78 basis points on a GAAP basis from 42.1% in the first quarter to 42.9% in the quarter just ended. The margin improvement was primarily due to seasonally higher payroll tax and benefits related expenses in the first quarter of each calendar year. Adjusted EBITDA margin remained above 50% for the fourth consecutive quarter and came in at 50.6% for the second quarter. Adjusted EBITDA set a new quarterly record of $112.2 million in the period, increasing 5% from $106.8 million in the first quarter. GAAP net income set a new record high at $69.3 million, or 93 cents per diluted share, up from $65.2 million, or 88 cents per diluted share in the first quarter. This was up more than 50% from the same quarter last year. Adjusted net income with tax benefit of $1.18 per diluted share was another company high, up 4% from the first quarter and 33% higher than the 89 cents per diluted share reported for the second quarter of the prior year. As we guided on our capital management priorities, we continued to reduce debt, paying down $57 million in the quarter, which was a 14% increase from the $50 million of debt repaid in the first quarter. This reduced our leverage ratio to 1.4 times by quarter end. Subsequent to quarter end, we repaid an additional $35 million. Additionally, we returned a total of $18.3 million to shareholders in the form of cash dividends and share repurchases. During the quarter, we repurchased approximately 288,000 shares, and our board approved a 25% increase in the dividend to 15 cents per share, payable on September 27th to shareholders of record on September 10th. Turning to slide 11, total AUM rose 5% during the quarter to $161.9 billion from a combination of market action and positive net flows. AUM is up 25% from the same time last year, with our long-term AUM ending the second quarter at $158.7 billion. On slide 12, we cover long-term asset flows. Gross sales increased sharply in the quarter. We achieved a 49% increase in long-term gross sales compared with the first quarter, and nearly doubled the level of gross sales during the same quarter a year ago. You can see the steady progress of our improving net flows depicted by the yellow line in this chart. After the fourth consecutive quarter of improvement, net long-term flows turned positive in the second quarter. The improvement in our net flows has been broad-based as we generated better net flows in the direct investor channel, the institutional channel, and in the intermediary retail retirement channel, where we continue to increase shelf space for our fixed income products managed by our USAA Investments franchise. For example, Schwab recently added the USAA Income Fund to its select list, and 6 retirement platforms added products managed by USAA Investments to their menus or select lists during the second quarter. Turning to slide 13, quarter-over-quarter revenues increased by 4% on higher average AUM. As we discussed on our prior call, a small amount of performance fees slightly boosted the average fee rate in the first quarter of the year. This, combined with slightly higher quarter-over-quarter waivers and reimbursements in the second quarter, contributed to the sequential decline in average fee rate. Additionally, Certain non-investment management related revenues, such as fund administration, distribution, and TA fees, while higher on an absolute dollar basis, declined as a percentage of assets due to asset growth, vehicle mix, and the fixed nature of some of these revenue streams. There was no quarter-over-quarter change associated with the fulcrum fees on certain USAA mutual funds. Those fees reduced our IA fee rate by 0.4 of a basis point in both the first and second quarters of 2021. Hence, we have significant remaining upside potential here. Beyond reaching break even, which would add 0.4 of a basis point to our company-wide realized average fee rate, we have the opportunity to earn positive fulcrum fees with the potential to increase our company-wide average fee rate by 1 to 2 basis points. As we have stated in the past, fee rate realization is less of a focus to us than profitability. We're happy to see our AUM increase in lower fee products, provided the margins meet our minimum criteria. The quarter-over-quarter and year-over-year margin increase in the second quarter nicely reiterates this point. Moving to slide 14, you can see our total expenses increased less than 2% from the first quarter. Lower quarter-over-quarter compensation expenses were more than offset by higher acquisition, restructuring, and integration expenses, which increased by $2.1 million in the quarter. The non-cash change in consideration payable for the USA acquisition earnout increased to $5.7 million, up from $2.5 million in the first quarter. This more than offset a $1 million quarter-over-quarter decline in other acquisition, restructuring, and integration costs. Non-personnel related operating expenses, which are highly variable, were up $2.8 million, or 5%, reflecting the increased level of AUM in addition to the continued investments we are making in technology, data, and distribution to drive future growth. You can see from the chart that cash compensation as a percentage of revenue was relatively steady, and the decline quarter-over-quarter reflects the seasonality of certain payroll tax and benefits costs. Also, as usual, the deferred compensation mark-to-market of $1.8 million was 100% offset by the unrealized gain on those investments below the operating line in other income. The non-GAAP metrics for the quarter are presented on slide 15. Adjusted net income with tax benefit per diluted share of $1.18 was up 4% from the first quarter and up 33% from 89 cents per diluted share reported in last year's same quarter. Adjusted net income of $87.2 million achieved in the quarter included a $6.9 million tax benefit. Adjusted EBITDA margin widened compared with the first quarter. We are continuing to make investments in the business, and thus we are still maintaining our adjusted EBITDA margin guidance of approximately 49%. As we've discussed in the past, this can fluctuate quarter-over-quarter and even year-over-year, depending on AUM levels and the timing and structure of our investments in the platform. Moving to our balance sheet and capital management activities on slide 17. Our interest and other financing costs are highlighted to illustrate the substantial decline in our absolute cost of debt since we originated the term loan in the third quarter of 2019 when we closed the USA acquisition. The result of rapidly paying down the debt, combined with lowering of our interest rate, has driven our run rate debt servicing costs down by nearly 2/3 over the past 2 years. As a reminder, our term loan is free of restrictive covenants, and all required payments have been made for the remaining term of the loan, and we have not drawn on our $100 million fully committed revolver. In the second quarter, cash generated from operating activities of $85 million was 14 times our cost of debt in the quarter. Additional capital management activities are detailed on slide 18. Our growing cash flow generation has allowed us to accelerate debt repayments and increase the amount of capital we are returning to shareholders. After repaying $50 million of debt in the first quarter, we paid down an additional $57 million in the second quarter, which lowered our leverage ratio to 1.4 times. Subsequent to quarter end, we paid down another $35 million, bringing year-to-date debt reduction to $142 million. This compares to a total of $164 million we paid down for all of 2020. At the same time, we returned a total of $18.3 million to shareholders through share repurchases and dividends. In the second quarter, we repurchased 288,000 shares. In May, we exhausted our former $15 million share repurchase authorization, and the board authorized a new program of the same $15 million size that expires at the end of 2022. We also announced our fifth consecutive quarterly cash dividend increase yesterday. The board authorized a 15-cent per share dividend, which is up 25% from the dividend paid in the second quarter. Since the second quarter of last year, we have tripled the quarterly dividend paid to shareholders while simultaneously accelerating debt repayments. That concludes our prepared remarks. I'll now turn it back over to the operator for questions.
Thank you, sir. At this time, we would like to take any questions you might have for us today. As a reminder, if you would like to ask a question over the phone, simply press star, then the number 1 on your telephone keypad. We have our first question from the line of Alex Blostein from Goldman Sachs. Please go ahead.
Great. Good morning. Thanks for everybody for taking the question. Dave, I was hoping we could start with your comments around M&A. You mentioned there are a number of potential targets that are in the very late stages, I think, as you described it, within your pipeline. Can you expand on maybe the size and capabilities of the managers that are kind of in this later stage bucket?
Sure. Good morning, Alex. I would say that really you could bucket them in two buckets. The first being, think of it as the impactful acquisitions, very similar to the THB and the Alderwood. So smaller, very strategic, brings us potentially organic growth, a different product, and really maybe gets us into a different distribution channel. And I'd say that's one bucket, and there are opportunities there. And then I'd say kind of on the other end of the spectrum, I would say transformational. Think of, in the past, a USAA acquisition for us, which is of significant size and scale, and brings us numerous things and probably uses more capital than the impactful. I'd also add maybe another twist to it, which is we have been evaluating managers in the alternative space. That's an area of interest. We've talked about that in the past. And when you think about, our platform and our business and, eventually the retailization of alternatives, meaning bringing alternatives to a buyer or a buyer set where you're thinking about buying, alternatives in maybe retirement accounts or in smaller investment accounts. We think that there could be some really potential opportunities there that could be very value added to our business. So we are evaluating those as well. So I'd really say it's two buckets, but with maybe a little twist on with the alternatives.
Great. Thanks for that. And then second question around the organic growth, and great to see an improvement in the net flow picture, obviously now positive for the quarter. Can you spend a minute on maybe sustainability of flows? And I heard you sort of mention that it's pretty broad-based, but maybe some specifics around net flows across the three categories that you described. So kind of self-directed, intermediary, and institutional channel. And maybe as a follow-up on that, I know institutional has been gaining traction for you guys. Maybe comments around the pipeline of institutional would be also helpful. Thanks.
Sure. So let me start off with, if you go back and look at the last few quarters, we've had an improving trajectory, and that has continued. And I think, I've used the term turning the corner, and I feel like we've turned the corner on flows. It is broad-based, and, I think all organic growth really starts with, are you delivering for your clients? So, do you have good investment performance? And, we do, and especially in areas that matter. And if you think about some of the investments we've made over the past year or so, think about the fixed income side with USA Investments. We've built that distribution quite significantly, and we've highlighted it last quarter. We highlighted some of it this quarter. That's starting to come in. Our institutional pipeline, as we mentioned, Some has funded, but it has continued to build, and that's really broad-based as well. You think about some of the acquisitions we did over the last 12 months with THB and the investment we made in Alderwood. We have not monetized those yet. Those are coming online, and I think those are a great opportunity going forward. And lastly, I'd say on the direct side, we have seen improvement over the last few quarters, and we continue to see improvement. And as we continue to build out that business and really build a digital marketplace, we think there's great opportunity there. So it has been broad-based, and you can see from our gross flows that we had quite a significant jump. There's a little bit of noise in that, but if you really peel it back, there's been quite an increase in gross flows, and I would imagine us, when I think about going forward in 21 and into 22, that would continue.
Great. Thanks very much for taking our questions.
Thank you. The next one, we have Kenneth Lee from RBC Capital Markets. Please go ahead.
Hi, thanks for taking my question. Just staying on the topic of net flows, wondering if there's any kind of items that you want to call out in terms of meaningful contributors to the solutions business inflows that you saw in the quarter. Thanks.
Yeah, I'll take that. It's Dave. No, our solutions business is really pretty widespread. Think of it as really an investment engine for us. We have our ETF platform within the solutions. So as we highlighted, I think it's the third straight quarter of growth for our ETF platform. We've launched, filed for 3 new ETFs plus the crypto ETF. So we think that's an area of growth. It's been growing. There have been some customized portfolios that we've taken on, which accounts for some of the growth. But we've talked about this for a while. The solutions platform is an area where we think we can grow going forward. It's growing today. And we think with what investors are looking for, we're able to solve a lot of issues in portfolios with that group.
Great. And just one follow-up, if I may. You talked about starting up a high net worth advisory unit within the direct investor business. Wondering if you could just further elaborate longer term plans and potential benefits that you could see from this unit down the line. Thanks.
Sure. It's really a group that's giving customized client service to what we define as high net worth investors in the direct investor business. It's early on. It's a high touch service. And, as we look at the profile of those high net worth and clients in the direct investor business, we thought it made a lot of sense to carve out a group. Again, I think there's great opportunity there to expand wallet share with that group, to gain new high net worth investors. And, we're in the early stages of that initiative and many other initiatives in the direct investor business. That's an area where if we look out a year or so, we anticipate that to be a driver of organic growth for us as well.
Great. Very helpful. Thanks again.
Thank you. The next one, we have Robert Lee from KBW. Your line's now open.
Great. Thanks. Good morning, everyone. Thanks for taking my questions. Maybe just sticking with flows, just kind of curious. I mean, fixed income performance has been good. You've pointed out, they're getting it on more platforms, the Schwab Select List. But, I guess this quarter, kind of, at least on the flow basis, kind of, felt like it slipped back. So can you maybe just call out if there were some particular one-time items, or how should we think of kind of the pickup in redemptions there this quarter, just given, kind of the positive underlying trends?
Sure. It's Dave again. We had one large client internalize their fixed income capabilities that we were managing for them. So I think there's a lot of noise in that total gross number. If you're able to see the detail, you would see that that has picked up, and especially with building out the distribution over the last few quarters, we anticipate X that one-time item, you'll see some momentum there on the fixed side. We're very encouraged with that platform, with the asset class. If you go back a number of years, that's been an asset class that has attracted net flow, positive flows. We have tremendous investment performance. We have a great team there in the USA investment franchise and in Incor. So we're really excited about that. And that's been an area that, again, we have built out kind of brick by brick on the distribution side. And, that's an area where we look forward. We think that's going to contribute to organic growth as well.
Okay, great. And then maybe just as a quick follow-up, as you pointed out, profitability has improved nicely. You have your EBITDA margins, now 50%, give or take a tiny bit. So understanding you don't manage to a specific margin, but how should we think of, the ability to, continue to kind of scale from here, or are there some additional kind of investments you're kind of planning on over the coming quarters or so that, may not put pressure on it, but may kind of limit, additional expansion if, assuming revenues can continue to trend higher?
Hi, Rob. This is Mike. Good morning. Yeah, that's a good question. As you said, this is our fourth consecutive quarter of 50+% margins. For us, that's not surprising based on the business model we have and the scalability of what we've built across our centralized model. We have in the past and continued, and in our prepared remarks, we'll continue to guide to 49% long term. We are making significant investments in the business, and that is included in our current 50.6% margins as well. But the areas that we are investing really around data, our distribution, and the digitization of our distribution across marketing and really all three distinct distribution channels that we have. And so we'll continue to make those investments, and you'll see those as we move forward. We'll have quarters, I think, we'll have quarters going forward that will be above the 49% margins, but that's still a long-term range. We think the business is scalable. Absent a large transformational acquisition, we'll continue to operate in the same level of margins that we are today.
Great. Thanks for taking my questions.
Sure.
Thank you. Next one would be Colin Johnson from B. Riley Securities. Please go ahead.
Hey, good morning. Thank you for taking my questions. First one here, just kind of looking at the new crypto ETF product. The registration statement has been filed with the SEC. Can you just remind us, where the SEC stands broadly on the issue? Have they, broadly given the okay for crypto ETF types of products, and you think it'd be relatively low approval burden from here?
Yeah, so it's Dave. They have not approved any of the ETFs yet, to my knowledge. What we actually launched was a private fund that's available today to accredited investors in the U.S. And our take on this asset class is that it's a viable asset class. We've had many conversations with many clients, and there are many clients that want exposure to this asset class. We've partnered with NASDAQ and Hashdex, two, I'd say, leading organizations. One, everybody knows NASDAQ, and two, Hashdex, in the crypto world is a leader and has been, managing crypto portfolios for a number of years. So we have a live product today that's available in a private setting, and the ETF that will eventually, hopefully, get approved over time with others. We think we'll just expand out our opportunity set there. We're really excited about this. One of the unique things about our offering is it's a collection of coins. It's not a single coin, so it's not a Bitcoin ETF or a Bitcoin product. It's actually an index. It's the NASDAQ Crypto Index that's rebalanced every quarter. And, today within the index, there are a number of coins. So if you're looking at getting exposure to the, to the asset class, this is a way to do it where you're almost getting, if you will, a benchmark type exposure. And as I said in my prepared remarks, we believe we're the first ones to file an ETF with this kind of product. So we're excited about it. And, over the last couple of days, there's been a lot of discussion from various folks at the SEC around regulation, and we actually welcome the regulation. I think with regulation comes institutionalization, so it gives many investors confidence to invest in this asset class. So we welcome the regulation. We actually are very happy about it, and we think as the SEC goes through and creates rules and regulation and even tax rules around this from the IRS, I think it's going to be great for the asset class, and we think it's something that's sustainable. We don't know the size of it. I'm not sure anybody knows the size of the opportunity, but we think we have a great product and a great offering, and we can be really competitive.
Great, that's helpful. And then kind of sticking with crypto, just recognizing these products are maybe still in their infancy. Do you have any kind of idea of what level of management fees these products might be capable of commanding? Just as we try to loosely gauge their revenue generation potential, might it be maybe a little bit higher, closer to a fixed income type product, or maybe lower, closer to a large cap equity? Or any color there would be helpful.
I think the fee rate and what the establishment of the fee rate in different products in different markets has not been established yet. I would imagine the fee rate would be higher than your traditional fixed income product, but I think that's yet to be determined as this asset class continues to kind of gain traction and mature. For us, we want to be relevant in clients' portfolios. We've always tried to be on the side of charging a fair fee, and we think that this product will have the same characteristics of what we've done with other products.
Great, thanks. That's helpful. Those are all my questions. Thank you.
Thank you. The next one, we have Ken Worthington from JP Morgan. Please go ahead.
Hi, good morning. So Victory continues to integrate a number of acquisitions. Maybe talk about your current top priorities on your list of things to accomplish still with regard to USAA and the other more recent deals that you've closed.
Hi, Ken. So from an integration.
All right, great question, but I'm done with the 5 years data. Like I said, it wasn't going to take very long. So you can do a little bit of analysis and kind of call it a day. Let's take a look. Pay no attention to the value up there. We still have a lot of things to adjust. So the debt to equity ratio is currently 25% after adjusting for debt and taxes and interest. Well, let me actually check on the interest rate. Coming to 7.63% for the rolling through your average aggregate. And on the book interest, I get 2.73. They have been extinguishing their debt early, which has led to excess costs for them. The way that what this is actually asking for in terms of my spreadsheet is actually an item that helps in terms of their discount a lot of the time. So oftentimes having the higher interest rate doesn't seem to affect it. However, in this particular case, it does seem to by showing that. So we can argue that they probably would be going towards that interest rate. Now they've been getting their interest rates down further, and they've been getting those excess extinguishment costs out of the way. It's more likely they would go in terms of their normal book interest debt. And yeah, so that brings their weighted average cost of capital down to about 4% relative to the 6.2% that we were saying before, or 6.2 cost of equity. That makes more sense. As far as the actual debt that we're going to expect for them, 0% as a base is probably fine enough. Maybe 50% is a reasonable assumption, perhaps 75%. And that leads to 25% expectation just on the base of it. Maybe we can push it up to 75%. That would push it to 35%. I think that's pretty reasonable. assumption overall. Yeah, okay. Let's take a look at that in terms of market cap. Okay. Returns on invested capital for the last 3 years, it comes at 13.5%, which is pretty significant relative to the cost of capital. Could be that the rate should have been lower. Okay, so their sales to capital ratio is significantly lower than we're saying here. Again, we would expect relatively low sales to capital ratio based off their industry, and we'd also expect a margin relatively low overall. That's what they get for having a low risk business overall. But if we actually adjust that into the sales to capital ratio, again, the last 3 years, it comes out to an average of 0.53. So this is all pretty high for them. We try to adjust down to maybe 0.5 being in the middle. We can literally put 0.53 in the middle, but I want to be maybe a little bit generous to them. Okay, we'll put like that. Maybe even a 0.6 just to get a little bit generous to them, but that's about as generous as it's going to get. And then we have to go up to margins. Again, 10% being the industrial expectation against a relatively low sales to capital ratio. Their margins for the last 3 years has averaged about 19%. Include the years prior to that, it was significantly worse. However, they were still kind of coming into their IPO, so we can kind of give them a little bit of the benefit of the doubt there. Since being a public company, this is what their actual average has been. So this is perhaps way too low. Push it up 30%. That puts the midpoint up to about 17.5. Because I would argue that this is probably a little high. Like this 15% average probably makes more sense overall than this 19.31%. Maybe 25%. That puts 15% directly in the middle. Let me push this up to 15%. So overall, we would be arguing that they have a pretty good sales to capital ratio for their industry and pretty good net margins. So overall, we would be arguing that they're better than their industrial average on both categories in this way. We haven't even adjusted the revenue expectations yet, but we'll get to that in a moment. Let's check on the tax rate. They have a pretty stable tax rate, so that's good. That makes that part of it really simple. These margin assumptions do bring their returns on invested capital down to a range that makes a little bit more sense, while still maintaining excess returns over the weighted average cost of capital. So that's still good. It makes sense, but it's not so far that it would be hurting them, punching them down unnecessarily. Revenue expectations. Okay, so now let's take a look at what the analysts are saying. And we're expecting 15.5% this year, and then 5.5% in the year after that. Let's go ahead and crack out some numbers. Is it 5.5 next year? And then we'll assume it does relatively steady state after that. So maybe we would expect $990 million in revenue in the 5-year forward period. approximately. Incidentally enough, what I have for the analyst number is actually already sitting at 990. That's kind of a coincidence, but it works. But it does mean that we like this 5% number as perhaps being our center, which means perhaps this is a little bit too low. If we push this up to 15, that would actually center it back to 5% there. At which point I would argue maybe it should be a little bit lower than that. Let's go with 13%. So I like the analyst number to actually kind of sit in this range right here. Analysts are usually a little bit more bullish. That is based off of 8 analysts, for the record. And then their EPS growth expectation is 11.7% per annum for the next 5 years. If we look at the 5% CAGR down there and tag that with 15% we're seeing here, that gets them to a minus 7% in net income. That doesn't take into account share buybacks, but unfortunately they don't really have a record of doing share buybacks in all honesty, so that doesn't really match up. So what this could say is that you could argue that we should expect a much higher margin for them in here, because if it takes 25%, suddenly you see that it gets actually positive territory for that. It's nowhere near 11%, but 3% is viable if you matched it with a pretty significant amount of share buybacks. If you punch in, for example, 27%, which is their current margin, or really 27.41%, then you get to 5% CAGR for the next 3 years. So it could be the analysts are assuming that this margin is going to stick forever. I think that's pretty ridiculous, though, to assume. So not going to do that. I guess that's what I'm going to say. I don't know, maybe we can push it up to 20% for that, on the assumption that the analysts are just being extra bullish. But that's about as generous as I can be. Beyond that, it would be kind of reckless. Trying to think of like extra ways that I could be generous to the valuation without being a little crazy about it. Pushes up to 40. I don't know about that. Year-over-year revenue growth since this started in our data set has been 37%, then they were flat, then 48%, then 26%. So there has been pretty significant growth as far as revenues go. We only have a 3-year CAGR, which is in the 23% range. So you could argue that this is way too low of revenue growth expectations, and that that's part of the issue. Okay. I think I'm pretty happy with those assumptions. I definitely think I was under assuming the revenues. I was kind of basing it too much purely off of those next few years and then moving it into steady state. But I mean, they've been growing a whole lot. I kind of was just kind of forgetting that fact. And they've been going through acquisition, and they were even talking about that in their call. So it's safe to assume that they might do another significant acquisition. I mean, you can really see that right here. It's like big acquisition, big acquisition. How big is their market cap even relative to those acquisitions? Yeah, so they're making pretty big acquisitions. It's part of where the revenue jumps come from. So it's pretty safe to assume that they'll keep doing that. It's just going to be costly for them. We again have to be tempered in our assumptions surrounding margins and capital. Leaving the margin assumptions relatively high overall, not as high as some might like, but we are trying to keep our capital assumptions relatively steady in regards to that. They definitely do a decent amount of dilution whenever they need to make those acquisitions slash issuance of debt, though they do pay down their debt relatively quickly. So if you have to balance all those things together, I'm pretty happy with these assumptions. The only thing left to do is to adjust for default risk, which I was saving for the end. Let's see, most recent year, a little under 1%. So let's see, yeah, basically no cash to pay off debt. So I say it's basically zero for that one. Relatively low. Okay, so I think that will do it. Is it importing the number? No. It sucks. Okay, so VCTR, Victory Capital Holdings, as I said, asset management and fund administrator and distributor. As they were talking about in the earnings call, they're working on a NASDAQ cryptocurrency index, so index of all sorts of cryptocurrency assets, stocks, and products, and creating an index therein. Not an index of cryptocurrencies necessarily themselves, but other things related to them, which is an interesting and somewhat unique product. First in line, a little bit over the toes as far as regulations go, but as they said in the call, they're marketing it to private and accredited investors currently, so it doesn't really matter. It's bypassing those publicly offered issues. Either way, interesting company. VCTR, Victory Capital Holdings. Today, the U.S. Treasury is selling for 1.63%. Equity risk premium comes to 4.73%. And based off of the risk that we associate for this company idiosyncratically, we come to a discount rate of 6.19% with a dividend currently being paid of 2.04%. They had sales in the most recent year of $775 million. 5 years ago, we don't actually have information on them from 5 years ago. We do have from 5 years ago, but not from the 6 year back, which would have been 5 total years of difference. So we don't actually have that information listed here distinctly. Sales of capital in the most recent year, or the last 3 year average, has been 0.53, which is high relative to the industry expectations we would have for them of 0.37. Returns on invested capital were 13.51% for them, which is pretty decent and well above their cost of capital. And debt to equity in the most recent year is currently a little under 30%, 28.75%. Their default risk for this debt is a little under 1% at 0.85% in the most recent year. And their profit margins are 19.31% for the last 3 years average relative to industrial expectations of 10.64%. So they do have relatively high sales to capital and profit expectations, which is one of the reasons we're looking at them, because of the combination of those two factors is an indicator of a high quality business model. Profit in the most recent year of $213 million and they're currently selling for $37.02. The distribution that we are decided to use is relatively even for them. I'm actually kind of tempted to adjust that a little bit. I was going to adjust that and I didn't, now that I'm thinking about it. Well, because we're going to lean out of the less likely outcome and more into the middle. $45, and then maybe 15 also is. So we're going to lean heavily into the middle, with it still leaning towards the positive end of things, but also a little bit less towards the negative end of things. Yeah, I kind of meant to do that before getting to this, but that doesn't adjust all the other things, so it's fine. Probability distribution, as I said right here, it's mostly normal distribution with leaning slightly towards the positive end of things. We have sales expectations 5 years from now, anywhere from $600 million of sales to possibly $1.9 billion of sales, on expected value of $1.1 or so billion of sales, which on a growth figure comes to an expectation of either -5% on the low end per year to possibly a growth of 20% per year for the next 5 years, on expected basis about 8.04%. Our sales to capital expectation comes to 0.52, which is basically in line with their current sales to capital ratio. We do expect their returns on invested capital to drop over this period to about 9.91%, which is still above their cost of capital. We expect them to issue new debt to achieve this, bringing their debt to equity ratio up to about 33.44%, and their default risk would stay basically about the same over this period on a distributed basis, a little under 1%, 0.85%. Profit margins we expect to come down over this period, which is why the returns on invested capital drops, but we expect it to end up in an expected range of about 16% over the period, and the profit expectations comes to about $197 million, but really it's just a distribution between somewhere between maybe $30 million in the worst case scenario to possibly a high end of $482 million. Based off the discount rate that we are using for them, we come to a present value expectation of $38.70, which is about 5% higher than the current price. We have 5-year forward value targets unadjusted for the dividends that they're paying out of about $13.32 to possibly a high end of $125.51. On an expected basis, we come to $52.03, which compared to the price it's currently selling at gets us an expectation of 7.05% per year for the next 5 years. The short-term multiple regression pricing over down here is basically meaningless because we don't have an analyst 5-year EPS number coming from the appropriate place into the formula, so we can basically just ignore that. But either way, interesting company, decent qualitative factors, but it is trading relatively too high for it to be a good investment overall for our portfolio. Just a decently high quality business as far as asset management goes. Usually it's a pretty low quality business to be in asset management, but they seem to be pretty high quality. So that's pretty good for them overall as far as business management goes. But as far as valuation for investment purposes, it's definitely not very appealing. Not at this time. It would have to drop pretty significantly first for it to be appealing. Probably below 25, maybe closer to $20 or something. That would probably make it a very appealing option. But whatever, interesting company to look at. Like I said, they expected this stream to be relatively short. We're coming in a little over an hour now, so I mean that is what it is. Shorter than normal, I suppose, but here we are, basically about done. So that's going to do it for us today. Victory Capital Holdings. The next company that we're going to be looking at on Friday is yet another Danish shipping company, similar to what we worked on Monday, though a little bit different. It's not going to have the same problems as we were looking at AP Moller Maersk. Instead, we're looking at Hapag Lloyd, Akkertekveschaft. I can't even remember how to pronounce it all that, but This is a little bit more of a pure play marine shipping company rather than a full-on logistics company / shipping company, which is what AP Moller Maersk is. But they are both Danish companies, which is interesting. This is actually going to be an official ADR versus the weird unofficial, unsponsored ADR that we were dealing with before. But either way, that's what we'll be working on Friday. So I will catch you all then. We stream 3 times a week, Monday, Wednesdays, and Fridays, usually around the time the market closes. See you all